Hello students, today we'll be doing the second topic, portfolio management. Security analysis and portfolio management together comprise 25% of your paper, 25% of the syllabus. Therefore, I am doing this in detail and want to ensure that all of you understand what we are doing. So today we'll start with portfolio management. First of all, we need to know the meaning of portfolio. Let us take an example. Suppose I have with me shares of, let us say, Reliance Limited, Reliance Industries, and I'm having with me 100 shares of Reliance. So this is the only investment that I'm having. So you ask me, sir, what is the total amount of investment that you're having? Let us say I purchase these shares and the market value of these shares is 800 rupees. I'm just example. So I will be having investments worth rupees 80,000. Now, since I'm having shares of only one company, that means my entire money has been invested in the shares of Reliance Industries. In that case, my total investment is 80,000 rupees and the total investment is just in one company. If anything goes wrong with the company, there is a problem, there is a labor problem, or there is a lockout, or the company is not performing well, then the market value of these shares will decrease and I may lose my principal amount also. Whatever I have invested, I may lose that entire amount. So to be on the safer side, what I do is I also invest whenever I get a second opportunity. I invest in, let us say, 100 government debentures or government securities, 1000 rupees government securities. That means the face value of each government security is 1000 rupees. And I purchase 10 such securities. So I'm having 10,000 here. Okay. Government bonds, you can say, government securities. At the same time, I may invest in Tata Motors and I may purchase some shares, say about 800 shares here of Tata Motors. So like this, I will be investing in different companies. So now I have got shares of Reliance Industries, I have got government securities, I have got shares of Tata Motors. I may take a fixed deposit in State Bank of India worth rupees 50,000. Okay, fixed deposit in State Bank of India. So different types of investments are there. I may invest in 8% debentures, 8% debentures of, let us say, Infosys Limited. Like this, I'm having investments in different companies. So now I'm having a collection of investment. The word that I'm using is collection. I'm having a collection of investments. So this collection of investment is made up of shares, okay. It is made up of a fixed deposit in a bank. It is made up of government securities. It is made up of debentures. Different types. So I'm having a collection of shares, debentures, government bonds, fixed deposits. This collection that I'm having of all investments, this entire thing, I will call it as my portfolio. This entire thing is called as my portfolio. So what is portfolio? Portfolio means a collection of shares, debentures, government securities, government bonds, fixed deposits with bank, and any other financial asset that I'm having. It can have property also. That is also an asset. If you remember in the very first lecture on security analysis, we had done the meaning of security and the different type of investments which are possible. So on the basis of that, we are having different forms of investment, shares, debentures, mutual funds, property, assets. So when I have my investments in different types of, in different forms, you can say, then I say that I'm having a portfolio. So what is a portfolio? A portfolio is a collection of shares, debentures, bonds, fixed deposit, public deposits, mutual funds, property, assets, financial assets, any other financial asset. Okay, it refers to a basket of assets or investments. So it is like a basket of assets. Okay, so whenever I'm talking about a portfolio, what do I mean? I mean a collection of shares, debentures, and different other types of investments. So, meaning of portfolio. It is a collection of shares, debentures, government bonds, and any other financial assets. Second is refers to a basket of assets. So normally the term used basket of assets, collection of investment together is called as a portfolio. Now we are doing the topic portfolio management. So what is portfolio management? Portfolio management is made up of four processes, or you can say four steps. What are the four steps? The four steps are: first, I require to construct a portfolio. Construction of portfolio means I have to form a portfolio. How do I form a portfolio? It is by investing in different types of financial assets, which will help me to have a portfolio of a variety of investments, different type of investments. So when I have a variety of investments, then the first step to that is, what did I do? I constructed a portfolio. So it is the first step is construction. Okay. Then maintenance of that portfolio means that I have to see which particular assets are giving me what. Some assets are in the form of shares, so I have to see whether I'm receiving dividend or not. Some may be in the form of debentures, some may be in the form of government securities, some in the form of fixed deposits with bank. So I have to see whether those particular assets are giving me the interest on the investment. So the second step is maintenance, you can say, maintenance of the portfolio. Okay. Then third step, I would normally say evaluation of portfolio. Evaluation of portfolio. Why did I have that portfolio of different types of assets? Because I had some target of income, that I want a particular amount of income to be earned by me at the end of each month, each year, whatever it is, whatever was the target. That this much amount of income I should earn from my investment. So I must have set a target, and accordingly I must have invested. So since I've invested by taking into account all these targets, what must have happened? What must have happened is that I'm going to either receive the same, or I may receive more than what I targeted for, or I may receive something less than what I targeted for. So, evaluation of the portfolio, finding out whether I'm getting the desired returns, the necessary returns or not. Okay, so that is the third step. Fourth step is what? Fourth step is that if I find on evaluation that my portfolio is not giving me the desired results, then in that case, I will have to revise my portfolio. So the fourth step is revision of portfolio. I have to revise my portfolio. Okay. So in that way, portfolio management, when I'm talking about, it is nothing but collection of shares, debentures, government bonds, and that is construction. What we are talking collection is construction. It's maintenance, evaluation, and revision. That together is called as portfolio management. What is portfolio management in general? In general, it is investment of funds in such a manner that I have different combinations, different types of securities. Where I'm trying to, why did I have different types of securities? Now, I had shares of Reliance Industries. I had shares of Tata Motors, which is going to give me dividend. But the dividend is not fixed. And I have got a target that I want to meet. That means I want to receive a particular amount of income for which I have set that portfolio. Suppose the dividend is not as per my expectation or the shares lose their value, then in that case, I should have something to support me, which from which I have a regular returns. So I'm having fixed deposit, which is giving me a fixed rate of return, debentures. Okay, so like that, I'm investing government securities. So I will be investing those particular assets also, which will give me a definite return by way of say interest. So minimizing the risk and at the same time trying to maximize my returns is what is called as portfolio management. So when I talk about portfolio management, what is portfolio management? It is nothing but the process of construction, maintenance, revision, and evaluation of portfolio. Four things are there: construction, maintenance, evaluation, and revision. Actually, revision should be the last thing. So if I find that a portfolio is not giving me the returns, then I find out which of the securities is not giving me the returns. So I find that okay, Tata Motors is not giving me the returns. The dividend has come down. So what I do, I sell off the shares of Tata Motors and I include the shares of some other company. I buy something else which will compensate. So a revision of portfolio. Revision means changing the portfolio as per my requirements. Okay. Then it is the investment of funds in such a manner. I told you we want to minimize the risk and maximize the profits. Combination in such a way that we have got combinations of different securities. Total risk of the portfolio should be minimized. So shares are having very high risk. I want to minimize that high risk. So I take next investment in fixed deposit debentures on which I'm going to get fixed returns. So combination of investments where the total risk is minimized and I'm trying to maximize the returns. The returns by way of capital appreciation, the returns by way of dividend, the returns by way of interest. So I'm trying to minimize the risk and maximize the returns. Now, next thing that normally the question is in the minds of the students is what is the objective of portfolio management? By doing all this thing, what are we trying to achieve? What is the benefit that we are trying to get? Objective of portfolio management. I am doing this because I am having a reason. What is that reason? That reason is to create a portfolio, to build a portfolio, to construct a portfolio, which gives me a return, which is I'm using a particular word, which is commensurate with, commensurate, which matches my risk. I want to get maximum returns. I want to become the wealthiest person, the richest person. But for that, to get maximum returns in finance, we have a rule. What is that rule? That rule is higher the returns, higher the risk. But I don't want a very high risk. I want returns very high, but not a risk. Risk I want minimum. I want to minimize the risk as far as possible. But I want the returns to be maximum. I want to minimize the risk and maximize the returns. Now you will ask me, sir, then you tell me what type of risk you want. I will say I want moderate risk. I don't want very low risk also because low risk means low returns. High risk means high returns. I want a moderate level of risk. I can assume, I can consume, I can bear moderate level of risk because I have got a limited income plus some surplus. I don't have indefinite amount of income. I don't have large amount of wealth. I've got limited wealth, and with that limited wealth, I want to get maximum returns. So level of risk, moderate risk. So building a portfolio commensurate with which matches with the risk that you are willing to undertake, matching with the risk that you are willing to undertake. That for that we use the word commensurate. Okay. So objective of portfolio management is to build a portfolio which gives a return commensurate with the risk reference of the investor. Commensurate with the risk preference means matching with the risk preference of the investor. That means to what level the investor can bear the risk. Okay, so we have done meaning of portfolio. I have done with you meaning of portfolio. I have done what is the meaning of portfolio management. 4 words I have told you. Okay, construction, maintenance, evaluation, and revision of portfolio. Now, this topic is very important. Don't take it lightly. So that is why I'm going in depth. I'm explaining each and every point to you in this particular topic. And every topic concept is very important. Until and unless you understand the concept, you will not be able to go ahead. Okay. So this is the objective of portfolio management. What is the objective? To give a return which is matching with the level of risk that I'm willing to undertake. Okay. So that is the objective of portfolio management. Now we have something called as optimal portfolio. Optimal. Optimal. Now, from the word optimal, normally students jump to the conclusion, sir, optimal portfolio means that which gives maximum returns. Yes, but you are telling me only half of it. What is an optimal portfolio? An optimal portfolio is one where I may give you the level of risk that I'm willing to undertake. I told you, moderate level of risk. I'm willing to undertake moderate level of risk. So given level of risk is moderate. For that given level of moderate risk, I want to maximize my returns. I want to maximize my returns. So if I get maximum returns for a given level of risk, then that is an optimal portfolio. Or I tell you that I want this much amount of returns. I give you the amount of returns that I want 12% returns from my investment. Now you decide where you want to invest and what you want to invest in. But I want 12% returns. So I give you the level of returns. For the given level of returns, if you design a portfolio for me, which gives minimum risk. So given the level of returns, a portfolio which gives minimum risk, or given the level of risk, a portfolio which gives me maximum returns. That is called as an optimal portfolio. So what did I say? A portfolio which offers maximum returns for a given level of risk or minimum risk for a given level of returns. That is called as optimal portfolio. Maximum returns for a given level of risk or minimum risk for a given level of return. Now we are talking about returns. What is this returns? This is the factor which motivates the people to invest. If I tell you, you invest in the bank, bank will not give you interest. Will you invest in bank? No. If you tell me, you give me the amount, I will invest in shares for you. Shares will not give you, I will invest in such companies where the company's shares are not traded only. They are not bought and sold in the open market. Okay. And they are not giving any returns also. They are not giving any dividends also. It is very difficult to sell the share. Will you invest in such investments? No. That means when I'm talking about returns, if I'm asking you to invest somewhere, there should be some motivating force. There should be some motivating factor. That motivating factor is the returns that you get, the interest that you get, or the dividend that you get, or the capital appreciation that you get. So that must be some investing motivating factor. So returns on investment, it is a motivating factor or the motivating force and the principal reward in the investment process. Now this returns is made up of two parts. What are the two parts? Regular cash receipts. In what form? Interest or dividend. If you are investing in government securities, interest. If you are investing in debentures, interest. If you are investing in fixed deposit of banks, interest. If you are investing in RBI bonds, interest. If you are investing in preference shares, dividend. If you are investing in equity shares, dividend. So regular cash receipts. Okay. Second is capital gains, capital appreciation. What is capital appreciation? I purchase one share for 100 rupees today, and after 3 months, the value of the share increases to 120. So market price of the share has increased from 100 rupees to 120 rupees. So in that case, the difference between what I purchased it for and what I'm having in the market, the increase in the value of the share, that is called as the capital appreciation or the capital gains. The difference between the purchase price and the price at which it can be sold, that is market price. It can be sold, that is market price. Followed. So this is the amount of returns. So returns is made up of two parts. Regular payments, either interest or dividend, or the capital appreciation that takes place. Okay. Now, the two factors that we were talking about, one was risk and one was returns. Now we have seen what is returns. That returns are made up of two parts. Now let us see what is the meaning of risk. Risk means risk means that my future returns, my future expectation is unpredictable, especially when I'm investing in shares of a company. Especially when I'm investing in the shares of a company, the returns are unpredictable. That means I do not know whether I will receive dividend or not. I do not know how much dividend I will be receiving. So there is an uncertainty. So uncertainty is called as risk. Another concept of risk, that my actual may be different from the expected. I'm expecting 12% returns, but I'm actually getting only 9% returns. Okay, so because of that, there is a risk factor that my actual will not be received, or my actual will not be received. The expected may not be received. My actual is less than the expected. That is a risk. So when I talk about risk, risk in investment means that the future returns are unpredictable, not predictable. If I invest in the stock market, if I had invested in the shares, what is happening? I invested when the stock market, when the Sensex was 40,000. Now the Sensex is around 23 to 30,000. It is moving in that range. Suddenly it is increasing one day, suddenly it is decreasing the other day. And it is increasing and decreasing by huge amounts. 2000 points, 1800 points. So when I purchased the share, the Sensex was 40,000. Now it has come down. When I purchased the share, I purchased it when the economy was very good, when Corona was not there. Now Corona is there. So dividend will not be there. Because no companies are working now. Companies are not working, companies are under lockdown. Entire nation is under lockdown. So where is the income generated? There is no profit. There is no dividend. So I was expecting the dividend. Now dividend has become unpredictable. I do not know whether companies will be working, whether now all the companies will start with a loss only. It is like you are starting business new. Everybody is starting new. So it is unpredictable. What is going to be the rate of return that I will be getting, actually getting? Correct? Refers to the chance that actual outcome will differ from expected outcome. And when I say differ from expected outcome, it means that is less than actual is less than expected. Expected is more, actual is less. I'm expecting 12% returns. I'm getting only 9% returns. So actual is less than the expected returns. Okay. Now see how I'm developing the topic and how you have to also understand the topic step by step. We started with what is a portfolio. We then went on to portfolio management. Then we talked about risk and returns. So we first see what is the meaning of returns. Then we see what is the meaning of risk. Okay. Now I'm talking about something like expected returns. My expected returns is 12%. How do I get this 12% expected returns? Isn't it? Now the next question is, how do I get this expected rate of return? So expected rate of return. I say that, I must have built some calculation. I must have done some calculation in my mind. And as per the calculation in my mind, I said that there can be three situations that may arise. What are the three situations? That there will be a very good economy. There will be a good economy, and there will be a recession, probability of recession. So three economic scenarios I've decided. Three economic scenarios. Very good if the economy is doing very good. Okay, GDP is having a very high growth rate. Then I'm expecting a return of 18% on my investment. If it is so normal, it's nothing something great, then I'm expecting something around 12%. And if there is a recession, I'm expecting something around 7%. You say, sir, what is the expected return? I want one figure, sir. You are giving me three figures. I tell you, yes, because there are three different scenarios that may take place. Now, I want average of this. How to calculate average? It's a simple, sir. You take the total of 3 and divide by 3. So 18 plus 12, 30 plus 7, 37. 37 you divide by 3, get something around 12 point something. That is average. No. Now what we are going to do is, this is not simple calculation, simple school level calculation. I will have to also give you, this is the expected rate of return, R. I'll call it as R. I will also have to give you P, or I can call this instead of R, I can call it as what? I can call it as, instead of R, I will call it as X, expected returns. Then I will have to give you probability. Probability that the situation or economy will be very good. Rare possibility. Rare possibility. So I say 0.2. Good, 0.6 or 0.7. Recession may be there, zero point 0.1. I was least expecting recession. But even then, now I multiply the X values, the returns to the probability. I get the product of this, that is P into X. Summation of that P into X, this figure is my expected return. So what is expected rate of return? It is the average rate of return. But how to calculate average now? It is the average rate of return. But how did I calculate average? By taking product of probability and the returns. Expected rate of return is the sum of total of this particular column, the product of each outcome or return and its associated probability. Correct? So what did I do? Return sum of the product of each outcome. So x into p, whatever was the value of p given here, I calculate p into x, and the total of this particular column is summation of p into x. How do I write this? Summation of p into x. Sum means summation. Product of multiplication. Each outcome means each expected return and its associated probability. So p into x. Okay, we'll see how it is done. Then the next thing that I'm going to say, probability is what? It is a percentage or the chance. What is probability? Is the possibility, percentage or chance or likelihood of the expected returns that I'm going to have. Okay, so now I'll just put up a table to show you what is actually going to happen, and then we will actually solve the problem and solve the example, and we will come to the conclusion. Okay, so we'll take a small example. Example 1. Suppose I give you this. Rate of return is actually x, this is p. Now let us calculate and see how much it comes to. Okay, we'll have a small column here, px. So now 20 into 0.25 is giving me 5. 10 into 0.25 is giving me 2.5. 1 into 0.25 is 0.25, and 5 into 0.25 is minus 1.88. Okay, because this is minus. Recession, I have taken minus. I have taken 4 economic conditions. If there is growth, if there is expansion, if there is stagnation, no expansion, no growth, nothing. If there is a recession. Okay, so for those 4 scenarios, I have taken 4 expected returns. I have taken the probability of each one of them as equal, 25%. I have multiplied, I have got this. Now total of this I should take. So if I take now total of 5 plus 2.5 plus 0.25 minus 1.88, I will get something like 5.87. This is just an example. I am just taking the example for you to understand that I will get this as 5.87. That means my average returns, that is x bar. Now x bar, I don't call it as x bar here. What do I call it as? I call it as R. Okay, I call it as R. X bar is equal to R is equal to summation of P into X, and that is equal to 5.87. That is equal to 5.87. So this is how I calculate the average rate of returns. Okay. Now let us come to the next concept. This is the average. How do I calculate average? Summation of P into X. Now the next thing is variance, sigma square, or standard deviation, that is sigma. Now if you go back to the example that I have taken here, what do we find? We find that the values of X are starting with -5 and it is going to +20. That means there is a wide fluctuation. What is standard deviation? What is variance? You must have done a little bit of statistics or mathematics, statistics that is, where you must have learned this standard deviation. It is a measure of dispersion. Measure of dispersion means what? That how far the data is dispersed, is spread. How far the data is dispersed or spread from the centermost value. What is centermost value? Average. So from X bar, from R, how far the data is spread, that is variance, that is standard deviation. So in that example, it was a case where I have got -5 on one hand and +20 on the other hand. So that is the spread of the data. What is the average data? The average data is 5.8. Average data was 5.8. So it is spreading. It is vastly spread. Okay. The dispersion of the data is called as a variance or the standard deviation. The dispersion is called as the standard deviation. So let us see what I've got here. In example number 1, we find that the possible outcomes range from -5 to 20. The average dispersion, this is the term, dispersion of the possible outcomes is explained by variance or standard deviation. Variance is the sum of the squares of the deviations from the expected value multiplied by the probability. Let us see if we can write the formula for this. Variance, sigma square, is equal to sum of summation of squares of the deviations from the expected values, x minus r, the whole square. Sum of the squares of the deviation is x minus r, multiplied by probability, so p into. The summation of p into x minus r the whole square. Summation of p into x minus r the whole square is equal to variance. Standard deviation, square root of this. Square root of this. Summation of p into x minus r the whole square. Okay, so from the definition you get the formula of this. So variance ka definition is Variance is the summation of the squares of the deviation as multiplied by the respective probability. How this is going to work? Let us see with the same example. I'll take the same data, okay, and I will calculate. Four conditions: growth, expansion, stagnation, recession. Returns are also given to me 20, 10, 1 and minus. So I'm taking the same data. 0.25, 0.25, 0.25, 0.25. Now I had got the value of R over there. Okay. So that value of R, whatever I've got, 5.8 or whatever it is. Okay. That particular value, I will subtract from each of these values. So 20 minus 5.8 the whole square. X minus R the whole square. Each square into 0.25. Okay. So 20 minus 5.8, 87 I something I got. Let us see, 20 minus 5.87 the whole square multiplied by 0.25 is 45.56. Whatever is R value, I'm not sure, I'm not taking the exact figures. So you will have to see, and on the paper when you solve, you have to see how much you are getting. So X minus R, whatever is the value of R, I do not know what is the exact value of R that I got over there, but you can solve it and get the value of R. Okay. So X minus R, whatever is the value, square that value, multiply by the probability, you get 45.56. 10 minus that value, square it into 0.25. 1 minus that value, square it, multiplied by 0.25. Minus 5 minus that value, square it, multiplied by 0.25. You will get all these values. Summation of all of this is 89.24. So the variance is equal to summation of P into X minus R the whole square. That is coming to 89.24. The standard deviation will be equal to square root of 89.24. That is 9.45. You can solve this at home when you're taking, when you're having a notebook and you're uh, going through the question. You can just solve this. First, get the value of R. After getting the value of R, each value of X minus the value of R, square it, and then get the value. Okay, I just give you a minute to copy it on this table. I think R is equal to 6.5. I made some calculation mistake there. R is equal to 6.5. So 20 minus 6.5, square it, multiplied by 0.25 is 45.56. 10 minus 6.5, square it into 0.25, 3.06. So R is equal to 6.5. Okay. As I said, if you are finding it a little bit too fast, you can pause the video at that particular point, complete your writing, and then proceed. Initial part we are just doing the concept, and immediately I will take up a few questions In the next session, I'll take up the questions based on whatever formulas we are doing now. Then we will move on to further concepts, further problems, higher level concepts, higher level problems. Portfolio management has to be done in its entirety. Everything should be done. Security analysis, you can do only those questions which I have done in this lecture, in the video lectures. Other questions you may just ignore. But portfolio management, you have to do everything because maximum questions are asked on this. And all questions are very simple. You have to just know the formulas. You have to know the application of the concept. Once that is done, you will be able to solve any problem under the sun. Okay? Done? Let us now come to covariance. Covariance, slightly you will have to understand. First, I will give you the explanation, then we will see what is the formula for that. In simple terms, covariance of returns on two assets. Now we are talking about not one asset, but two assets simultaneously. Measures their co-movement. Okay? Covariance is the sum of the product of each deviation of returns of two assets and the respective probability. So I will have to see what is the formula that is going to be derived from this. And third is that covariance may be either positive or negative. Okay. Now, first thing, let us see the formula for this. Covariance is the sum of covariance is the summation of product of each deviation of returns. Suppose there are two securities, X and Y. Okay, there are two securities, X and Y. So product of the each deviation of returns. So X minus X bar deviation from X bar. Second security is Y, so Y minus Y bar. Product of each deviation of returns of two assets and the respective probability multiplied by P. So what is my formula for covariance? This is my formula. Summation of P into X minus X bar, deviation of X from its average returns, deviation of Y from its average returns. Okay. So product of each deviation of returns of the two assets and their respective probability. Covariance may be either positive or negative. That means whatever answer I get over here, it will be either something like minus 3.5 or I may get is equal to something like some positive figure or is equal to say positive 32. Now I am not concerned with the figure here. I am not concerned with the value. I am not concerned with the I am concerned with what? I am concerned with sign. Negative sign, positive sign. I am not concerned with after that what is the digit. I am just concerned with the sign. And therefore I am saying that covariance may be either positive or negative. I am not discussing the value at all with you. Okay? Now let us see. What is the meaning of a positive covariance and what is the meaning of a negative covariance. Positive covariance and negative covariance. What is positive covariance? If the returns of X and Y are both above their average returns at the same time, or both are below their average returns at the same time. This is important. At the same time. Then there is a positive covariance between the two securities. Let us say that the two securities are X and Y. And X bar and Y bar are given to me. X bar and Y bar are given to me. Or I have calculated X bar and Y bar. And I find that X bar is 70. X bar is 70. Y bar is 45. Okay, this is the data that I have got. I have calculated. Now I say, At a particular point of time, my x value is 72 and my y value is coming to 49. What do I say? I say that both at the same time, x and y, x is above its average is 70. It's above its average, y is also above its average of y is 45. So x value is also above its average, y value is also above its average. So it is a positive covariance. Second example, x value at a point of time is 38 and y value is something like 27. 27. X value is 38, y value is 27. X is below the average is 70. So x is below 70, below its average. Y is also below its average. So here also we say that this is a positive covariance. So what is positive covariance? At the given point of time, both are below their average returns or both are above their average returns. Here both are above their average returns, here both are below their average returns. So at a particular point of time, if the averages of both of them are, if the values of both of them are above their average, or if the values of both of them are below their averages, then we say that there is a positive covariance. Okay. Now let us come to negative covariance. You have understood positive covariance now. Let us come to negative covariance. What is a negative covariance? Lectures are becoming interesting, isn't it? Negative covariance. If the returns of x, if the returns of x are above its average returns, while that of y are below its average returns. So one is above, one is below, or vice versa. Then there is said to be negative covariance between the two securities x and y. Okay. In positive covariance, both were above at the same time or both were below at the same time. Now for negative covariance, what I'm saying, one is above its average, the other is below its average. Then there is a negative covariance. Followed? Any problem? This is about covariance. Now there is another similar term, correlation. In covariance, I've told you, I'm not concerned with the digits, I'm not concerned with the figures. I'm concerned only with the sign. But in correlation, I'm concerned with both. I'm concerned with the figure also, I'm concerned with the sign also. So what is correlation? Correlation between two securities. Correlation between two securities is the measure of the relationship between the returns of the two securities. Let us say the two securities are taken as X and Y. Normally we take it as X and Y. Or one is shares of Reliance company and one is shares of Tata Motors. Two securities. How their returns are going to move, whether they are going to move in the same direction or whether they are going to move in opposite direction. That is correlation. If one goes up, the other goes down. If one goes down, the other goes up. Relation between the returns of the two securities. That is called as correlation. The value that we get, that we calculate, is called as correlation coefficient. So correlation is a measure of linear relationship between the returns of two securities. All these things are not there in my book because these are statistics which are to be done and known by you. Therefore, I am doing it separately over here. I want you to make a note of this in your notebook because these explanations of these concepts are not there. I have given you directly the formula. I have not given you explanation of the concepts. So you have to make a note of that when you are writing it in your book. Okay, what is it called? It is called correlation coefficient. How it is expressed? It is expressed as Rxy or Rxy like this. That is, it is a correlation coefficient between security X and security Y. Now, if I am talking about correlation between the security and a market, security and Sensex, security and Nifty, then what do? I write it as RSM, where S stands for security and M stands for market. Okay, so if it is between two securities X and Y, either I write it as XY, RXY, or this way in capital, RXY, XY capital. If it is between security and market, I write it as RSM. This is subscript. Okay, it is not RSM, not RSM, not RSM. It is RSM. SM is subscript. It is written below. Okay, have you understood? Now, as I told you, in correlation, I am concerned with the values also, not only the sign but the values also. Now, the values of this correlation coefficient RXY or RSM, they always lie between any two securities, between the security and market. The correlation coefficient should not be more than +1, should not be less than -1. That means it is between -1 and +1. Lowest figure -1, highest figure +1. It cannot be more than that, it cannot be less than that. It can be 0. It can be 0. Okay, it can be decimals. It can be 0.89. It can be -0.25. It can take decimals. But it cannot be more than 1, it cannot be less than -1. Okay, so I say a correlation coefficient ranges between what is the range? -1 to +1. Ranges between -1 and +1. Now, now all these things we have done in statistics. As I told you, I have not included this in my material, in my book, because this has already been taught to you in statistics at foundation level, at BCom level, at BBA level, whatever it is. This is kid stuff. This is stuff of students who are in the lower level, foundation level. So I assume that you are having knowledge. Therefore, I did not put it in the book, but explanation becomes important. Therefore, I am putting it in the video lectures. Now, correlation coefficient, I told you it is between -1 and +1. If it is exactly equal to +1, it is perfectly positive correlation. If it is exactly equal to -1, it is perfectly negative correlation. And if there is no relation, then it will be 0. If they are not related to each other, then it will be 0. Acha, suppose it is Rxy is equal to 0.8 plus 0.8, positive 0.8. Is it 1? No. It is something between 0 and 1. It is positive. So it is positive, imperfect positive correlation. Imperfect positive correlation. Suppose it is Rxy is equal to -0.37. It is imperfect negative correlation. Imperfect negative correlation. If it is exactly +1, perfect positive correlation. Exactly -1, it is perfect negative correlation. If it is between 0 and 1, it is imperfect positive correlation. If it is between 0 and -1, some decimal, then it is imperfect negative correlation. Clear? Now we go to the list of formulas which are there, which we have to study. The first one I have already done. Some of this I have already done with you. Expected return, I have done this with you. Okay. Expected return R is equal to summation of P into X, where P is the probability and X is the possible returns. It is X. So P is the probability and X is the possible return. Now this list of formulas is there in your study material, in my notes which are given to you in the PDF format. Risk measurement. Risk measurement is always standard deviation or a variance. Standard deviation square root of, this also we have done, square root of summation of p into x minus r the whole square. Now to study these formulas. That is why in this lecture I am discussing only the first part of the concepts and the formulas. Second lecture I will be following up with the problems based on these formulas only. Problems based on the formulas. Or if not, I may continue in this lecture only. Okay. Coefficient of variation, CV. It is not coefficient of correlation. It is coefficient of variation. Standard deviation upon R. Or it is also written as standard deviation upon average. R is what? It is nothing but average. Okay. Then we have expected returns of portfolio. Expected return of security is summation of P into X. Expected return of portfolio is the summation of W into R. W is the weight of the respective security. That means if you are having three securities A, B, and C, okay, A you are having investment of say 1,000, B you are having investment of 7,000, and C you are having investment of 2,000. Total investment is 10,000. Now what is the weight of A? Weight of A in the entire portfolio is 10%, so 0.1. What is the weight of B? 7,000 upon 10,000. Weight of B is 0.7. What is the weight of C? 2,000 upon 10,000. 0.2. This is the weight. So in the total portfolio, what is the weightage of each security? That is the weight. Okay. So instead of multiplying by probability, you multiply by the weights. Correlation coefficient Rxy. Formula covariance of xy, the whole divided by standard deviation of x into standard deviation of y. Covariance of xy upon standard deviation of x into standard deviation of y. Up till here it is clear. Risk of the portfolio. Risk I said what? Standard deviation. Now I am talking not risk of the security but risk of the portfolio. Earlier it was risk of the security. Now I am talking about risk of the portfolio. Let us go back and see. Risk measurement of the security. This is of security. Individual security. Individual security. Now I am talking about what? Risk of portfolio. Entire portfolio made up of maybe two securities. If it is two securities, then it is standard square root of weight of the first security square into sigma x square, that is standard deviation of the first security square, plus 2 times weight of x, weight of y, correlation coefficient Rxy, standard deviation of x, standard deviation of y, plus weight of y square, sigma y square. Now I want to explain this particular formula in detail. Since we have done correlation coefficient, there comes an excellent point over here which you have to note. So let us see what is the point. I have taken that formula here. Okay. Now suppose Rxy, that is correlation coefficient, is perfect positive, +1. If it is +1, then what will happen? This will become +1. It is as good as not there. It will be 2 times weight of x, weight of y, sigma x, sigma y, because Rxy is 1. Now what is going to be the result of this? See like this. I am going to rewrite this. The first term I will rewrite as Wx sigma x the whole square. Instead of taking square of each one of them, I have taken the square outside, plus 2 times Wx Wy sigma x sigma y, plus this again I will take weight of y into sigma of y the whole square. Square comes outside. Okay. Now this is of the type a square plus 2ab plus b square. You remember this quadratic equation? A square plus 2ab plus b square, which can be written as what? A plus b the whole square. Am I right? This is a square. This is b square. This is 2ab. Weight of x, sigma of x. Weight of y, sigma of y. Correct? So I will write it as a plus b the whole square. So what will it be? It will be root of, what is A? Weight of x, sigma of x. What is B? Weight of y, sigma of y. The whole square. Square and square root will cancel. What will happen? Square root of, sorry, square root and square root will cancel. So in that case, what will be I get? I will get simply weight of x, sigma x, plus weight of y, sigma y. So if it is a perfect positive correlation, then I will not write this entire formula straight away. I write like this: weight of x, sigma of x, plus weight of y, sigma of y. Similarly, if rxy is equal to -1, then sigma p is equal to weight of x, sigma of x, minus weight of y, sigma of y. It will be minus. Here it is plus. Here it is -1. Here it is +1. Now this I want you to make a note of, because I will be, if they tell me in the problem it is perfect positive correlation, I will straight away write this. And if they say perfect negative correlation, I will be writing this. I will not write the lengthy formula then. Followed? So that is why I want you to make a note of this. If Rxy is equal to +1, how it will, need not write the steps, or if you want you can write the steps, but this is what we are going to follow. If R is equal to, correlation coefficient is perfect and positive. Perfect positive correlation. Okay, done with this. Now you can revise the formulas. I'll get back to you. So, students, now you have got the first part of portfolio management. Lot of theory is to be done, lot of concepts are to be learned. I've given you a list of 6 to 7 formulas to be studied, so that next lecture when we start with, we can directly start solving the problems based on the formulas that we have studied today. So, for the next lecture, it is important that you learn these formulas. In the next session, I will be taking up questions based on this, and then we will be moving on to further concepts to be done. Lot number of concepts are to be done in portfolio management, so that you are able to solve the problems. So till the next lecture, I wish you all stay safe, stay at home, and God bless you. Till we meet next again. Thank you.